Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on May 9th, 2022. A reminder, we have trading tomorrow at 11 o'clock Eastern Daylight Time. A little bit of a change. I want to talk more about the Fed and the market. I think you would all agree that that's appropriate right now, rather than we had a lot of rolls, a lot of trades last week, rather than getting into the nits on that. And I want to talk about something that prompted a few emails because the amount of cash we gave back. But on the other hand, we had a great return on Zim integrated shipping. It's sort of living proof. You can trade through this market, but you have to change a good part of the time. You may have to change how you do it. The results last week, it was a very busy week. It was dominated by reaction to the Fed. It's the fifth week in a row that saw the S&P 500 fall. Now, that is the first time this happened in more than a decade. We saw two or three times the daily volatility, intraday volatility, could go from 1.5 to 3%. This time last year, maybe 15 months ago, you could look back and say for 5 years we had the lowest amount of intraday volatility, below 1.2% since the 1960s. And so things have changed. It's clearly a reaction, short term, inside the day, to people adjusting. Professional traders adjusting how they're reacting to the Fed. But there are other things obviously going on. And one of the reasons I don't want to pour through the results, which would take 15 minutes, is it produced anomalous results that were very positive for us. Actually, cash generation last week was huge. I hope you take that, and I'll review this next week. I hope you take that as a given that this approach of cash first is what you do to outlast a short-term or even a medium or long-term downturn in the market. The NASDAQ is in bear country. The S&P is getting there. Bear is defined as 20% or more. And one of the things that's also going on is market reactions to specific companies and sectors. And what you're beginning to see, remember, the market theoretically is a forward pricing mechanism. It forecasts 6 months out, supposedly, despite an intraday move up or down. The underlying sentiment now is that, corporate profits, people are going to pull back. And there were very high expectations of continuing almost pandemic style growth in the online companies. And you can take a look at Shopify and Etsy and eBay. And of course, Amazon. And there were significant sell-offs. Now, part of the sell-off was because Amazon missed in terms of expectations. The numbers really weren't good compared to what Wall Street was expecting. When Amazon goes down, it pulls the entire pack of online shopping down, in part because of the way funds are managed. And athleisure went down as well. And yet it's the number one sector by country mile in terms of dominance in the real world. I suggest you go through your photo album. You take a look if you have any casual pictures 10, 15 years ago of what people are wearing, and then take a look at today. And you'll see that Skechers are being worn to weddings. Lululemons are being worn to weddings. And so, $300 Lululemons. And we need to exploit this, as opposed to exploit starts with being conservative. It's not something, you don't try to catch a falling knife. The bottom line is you want to take a look at this, and when you see short-term bottoms coming in, the way, for example, we do with the trade desk, which is an extraordinarily volatile stock, you trade a silly put, you trade something 10% out of the money. There are things that you can do to actually take advantage of this kind of volatility. But the bottom line is consumers are still spending money. Hidden in the the GDP report, which was negative because of the trade balance and because of inventory build down as opposed to inventory build up, was consumer spending was up 2.7%. Now that trails inflation, but it means it's still there. Now, what does this mean? It means that we have to go a little bit more, perhaps a lot more, thinking about how the market is going to trade itself. So 4,100 has proven to be a support level. I hope you love my handwriting. And so it's possibly a good sign. Now, we're going to open today, depending upon when you listen to it. I'm recording this about 10 to 9. Futures are way down. But we've seen futures have the market down to about 40.50, 40.30. We've seen this before, and the market comes back to 4,100. So this chart and these support levels are important because, well, we as individuals make up a small percentage of the market. Professional traders make up a large amount. Robots make up a huge amount, and robotic algorithmic trading, excuse me. And also investors are waiting, meaning if you there's enormous amounts of cash on the sidelines. Maybe they want to buy Under Armour, maybe they want to buy Amazon, but they're going to wait until they see stability. And 4,100 holding another week or two would be a really big deal to bring some positive, optimistic, bullish investment kind of money, long-term money into the market. But a lot of that, of course, is what's going on with the Fed. And the Fed said, yes, there are more 0.5% increases on the way. But one of the things that led to the rallies toward the end of the week was the language was kind of dovish in that it didn't say what it did say 0.75% increases are off the table for now. And they did not say there'll be a lot of 0.5% instead of a lot of 0.25%. They said they will continue to be data dependent. And when they say data dependent, it's funny to put it in writing, they really do mean data dependent. And the issue, and you just saw this in the previous slides, is are we going to head to a recession? Europe is definitely going to go in recession. And will the United States follow because of the Fed putting the brakes on things? It's very hard to say, meaning we had sector sell-offs because things didn't grow 25%, but they still grew in double digits. So it's a difficult thing to say, but the street is pricing in negativity, and there's a bearish attitude because of the spillover from the bond market. So you have a lot going on. You have the Fed, you have the Ukraine. They're both priced in. Ukraine is priced in to be a non-weapons of mass destruction, grind-out war. It's where it looks like, and not the betting money, but many diplomats very familiar with Central Europe and Eastern Europe see this as being a North Korea, South Korea solution, that there'll be some sort of a peace discussion sometime, and that Ukraine will never give up the eastern part of the country and recognize Russia. The Russians will not back off, and there'll be grinded out warfare, and then maybe peace and stasis, but no recognition. What does that mean? It means that sanctions on Russia will continue, and that guarantees a European recession. And the continuings, I'm using sophisticated trading language, continuing to mess up because COVID's not fully priced in related to supply chain issues in China. And then you have to start looking at individual companies. For example, there are companies that don't get chips from China. So China makes a lot of lower value, older design, commodity kind of chips, which are vital for zillions of things, from cars to the control boards on $1 million storage devices used in server farms, and they're called EPROMs, or it's a basic this, that, or the other thing. It does affect the assembly of devices, but it's not microprocessors and it's not advanced memory. So all this adds up to we're going to grind away. The tactics are going to be more and more silly puts, more rolls, and more closing early. I will continue to focus myopically on cash generation because we know from more than a decade of trading, a crash, 7 corrections, never before 5 weeks of the S&P going down like this, we grind it out, and cash will outperform the market. Does it mean if the market's down 20%, we'll be up 20%? Not an overall portfolio value, but if we're up 25 or 30% in cash and the market's down 20, we're up 5 or 10%, and you're doing a lot better than your neighbors. And what an example of these, the tactics you need to use in this kind of a market is what we did last week with Zim Integrated Shipping. So Zim was pointed out by a member. Thank you. And prices are rising and being passed on, and being accepted and being passed on by retailers or business-to-business companies due to fuel surcharges. Labor shortages are very significant in shipping, and one-way shipping, meaning things that are being shipped from China to here, there's nothing going back to China, and so forth and so on. I use that as an example because in Shanghai, for example, there's a priority in getting ships out. There's not a priority in getting ships in. It's a market leader both in moving boxes around, but in the way they move boxes around. It's a high flyer during the pandemic. It fell to earth. When you're doing a longer-term trade, which is what we did, it was, even though it had weeklies, we sold something a month out. You have to add to the 3, 5, and 10-day short-term charts that you and I typically use to look at short-term money flows and bottoms and etc., you have to look at the 90 and the 100-day moving averages. Chains were liquid enough; they weren't great, but they were good enough, and gigantic premiums. So the low on the 90-day chart was 52.50, and you can see at the low, the red reflects stocks being sold at a lower price than the previous trade, and then all of a sudden, when you hit that low, you see things coming in, and you can see that this is immune from movements in the market. 180-day chart tells you the same thing, and so you have confirmation. Now, if you look at the white line is indicating how often it's trading below its moving average. This is a simple moving average, and the bottom line is if you went through every single day, it trades about 2/3 to 70% of the time above its moving average, which of course doesn't reflect what's been going on in the market. So remember, this is a stock to invest in as opposed to just to trade. This is a great company, and I think one of the reasons you'll see a lot of green come in is just people will say, a Warren Buffett type investor going, this is what the company's worth, and the stock now says it's being traded at less than that. Let's go buy. So the specific trade was not quite a silly put. It was very close. It was almost 10%. So we sold we sold a couple of weeks ago. We sold something expiring on May 20th. The $55 put when the stock was at 59.34. And the 3 to 5 day chart, which is not up here, was showing that we might even quickly come back above 60. So there was sort of a lot going on, but with a monthly trade, I have not used a 90 or 180 in these updates for you. I wanted to show those. So you can see, and let's go through the specifics. It's a 58% potential annualized return. It's a market leader, the stock price, and so forth and so on. And you can see where support was. So what happens is when you do the math here, selling at 55, if you subtracted the premium, you'd be at right below the 250 previous low. This means you can buy yourself time, and this means if you were assigned, you're going to be assigned and have a cost basis below the previous low. So that's how we open. Now the question is, why do we close it and spend so much money? Well, it's no longer potential, and that I highlighted that. I highlighted that maybe in the alert that went out, it should have said rate of return. It's no longer potential. It's a 44% annualized return if we closed at those prices. A lot of cash to give back. I know that made some people grumpy, but we always had to avoid earnings. We were never going to hold into the 20th. Our target, as you remember, is 32%. When I initiate a trade on an annualized return, we're comfortably above that. The stock was at 62, as 60 did hold. You're now $7 out of the money, and people would say, well, $7 out of the money, but you're also several weeks away or many days away from closing the trade. So we closed the trade this way. The goal was 32%. The market activity was certainly erratic and certainly subject to Shanghai, to inventory numbers, to fuel prices, to COVID, another outbreak in another Chinese city. So the rate of return at 44%, the profit of $100 a contract was really, really good. And this is why I keep on emphasizing, for those of you who are looking at portfolio values sinking but cash pouring in, when the cash pours in, it tips over, and all of a sudden you're taking a look at over a 3, 6, 9, 12-month period, like 25 or 30% rates of return, 35% rates of return, manifested itself in 25, 26, 27, 23% gains in cash, which overcame a 20% decline in the market. And going forward, you're going to see more of these. These are very good trades to put on and manage given current volatility. Response is, if there are spikes down, there are also spikes up. And if we do the trades the way we did the Zim trade, then we sell after we sell a put, it strikes down, as I said, the short-term type chart was near 60. We sell a put, then we long date it, and then when we get a pop, we have to give some cash back, but we make a very tidy annualized return, a very tidy profit. So near silly puts, which are 10% out of the money, or silly puts themselves. And as I mentioned last week, it's renting or owning. Zim is a stock with the market subject to what's going on with supply chain issues. It's a stock you rent. You go in and out of. You're not going to tell yourself you're going to trade it continuously for 18 months. despite great value in the company, it's something you have to be careful. And you go, I'm going to rent it, but I'll trade it this week. Maybe I'll trade it after earnings. Maybe I'll trade it 3 weeks after that. And to those of you who send emails going, why are we spending all this cash? Please don't get greedy. You close when you hit your goals. You close when you hit your target. And even if I do not put a good until canceled on, put your target in the form of a good until canceled order and put that order on after you make the initial trade of the put. This is Michael Schulman. Thanks for listening.